Welcome to Al Stock Trades. In this channel, we like to talk about undervalued stocks and bring in Warren Buffett's investment philosophy along with Cathie Wood's disruptive tech thesis to ascertain both levels of investing, essentially finding undervalued growth stocks. And right now, we're in the perfect market for this. You guys all inspired me with the whole retail investor push during the pandemic that I decided to create this channel to give you guys my 10 years worth of experience. The problem with Clover Health is that the information that's existing online, it's very difficult to access. And in fact, when you look at Morningstar, Yahoo Finance, a lot of it's honestly wrong. And it's really hard to get in that data. So I created all these graphs to give you guys how Wall Street, hedge funds, and essentially money managers look and ascertain and evaluate a business, right? So here we go. So as you can see here, the first one I would like you guys to talk about is the key fundamentals of Clover Health, right? As you can see right now, we're getting to a point where the revenue of how much it brings into the front door is actually higher than the actual market cap of the business. I expect them to report in 2 weeks from now that they are going to have around 1.45 billion. Again, these are in millions, but again, 1,000 millions is a billion, right? I expect them to have higher revenue than the actual market cap of the business. And a lot of these, a lot of you guys I've seen on the Reddit page, you guys are very intuitively, you guys are all amazingly smart, and you guys all figure that out. The beautiful part is, and again, please ignore the PE ratio here. I put PE ratio to compare others in the industry, but honestly, we don't really use PE ratio when we evaluate growth companies. We kind of stick to PS ratio, right? The price to sales. So the biggest problem that we have with Clover Health, the elephant in the room here, is that it's non-profitable. And I'm going to give you guys a projected free cash flow with revenue as well, which will align and get us ready for the earnings report come, I believe, February 23rd, 24th. So first things first, we want to go ahead and do an income analysis. By doing that, we look at the revenue and we subtract it essentially from the cost of revenue. We want to see, what's left over with Clover Health. And as you can see, the gross profit is negative 130 million. In fact, that's actually pretty good. Other companies out there have a more negative number. So we are on the path out of negativity. And Clover Health is doing really good in terms of increasing its revenue. But that's the thing about investing in growth companies. If you want high returns, you're going to have to settle with this and expect the volatility that comes around it. So I expect hopefully that this year they will make strides at decreasing these numbers and slowly increasing these numbers as well away from the negative $526 million. Here is a beautiful graph. So I need you to focus on this graph here because this is a very special one, right? So here we're going all the way back to 2018 to 2021, but then all of a sudden here you have 2022 future projections. Then you have 2023, 2024, right? That's the power of math, right? We're able to project it and quantify everyone's model and include it with in this graph. Again, I have a background in math and coding, so I use that to my advantage to essentially give me an edge in the market. So when we look at this here, we see the y-axis is in millions, and if we project out by 2024, we're expecting to see Clover Health at around $4 billion, right? But let's put that to the side and let's talk about the free cash flow, because that's the most important part in a business. You see, a lot of these YouTubers, they don't talk about cash flow, right? Free cash flow. And, again, that's why I came online. I realized that, I need to teach people this, because if you want to invest in a company, if it's not generating free cash flow, then you're just investing in a story, and stories don't make you money. Okay. So in any case, here's $0. It seems to me that Clover Health will be at around a path of profitability at around 2024. And again, these are conservative numbers. We might actually hit this in 2023. Again, the coronavirus has really put a strain on Clover Health's earning potentials. As you can see, it decreased during 2021, right? Because the pandemic happened here and we were actually rising up doing well. And the pandemic happened and then bam, we slumped down, right? But now we're finally on an upward trajectory. We did a share dilution, and I will explain to you why that's good based on another graph that I created. And if you can see here is that we might be hitting a path of profitability, might actually be 2023. But again, from this data, 2024. Now, let's go back to that revenue I talked to you about $4 billion. See, right now we're trading at a revenue multiple of 1, which means that Clover Health's market cap, as I stated, was around let's pull it up here. It's about $1.2 billion, right? So if we were to trade at a market cap of $4 billion, and assuming that The stock market is still terrible. The Russell 2000, all the stocks are still down, literally almost 80% down from their highs. Based off of these projections, this stock should be trading at $8 in about 2 years from now. $8.50, $8.50. That's assuming the same mentality, the same terrible evaluations that Clover Health is experiencing now at a revenue multiple of 1, right? Obviously, that's not going to be the case. I've seen this trade even higher than what I'm about to tell you, but at a 9.7 times revenue multiple. I would say a 5 times revenue multiple would be great. So I would say this stock in 2024 could go all the way from $8.50 because, that's assuming that the market's bearish, all the way to $50 in the middle, all the way to $100. Okay, guys? And again, these are revenue multiple projections. They're not as accurate as my DCF intrinsic value calculator. And if you want that, there'll be a link down below. Let's move on and look at the financial health of the company, right? To do that, you want to look at the short-term assets, combine them and see if they can pay off the short-term liabilities. And as you can see, the short-term assets can definitely pay off the short-term liabilities. Now, you would think that you would use the long-term assets to pay off the long-term liabilities for Clover Health, but that we don't do that. In fact, if you see, long-term assets for, people that are interested, it's like buildings and whatnot. If you see a company that's selling their buildings to pay off their debt, you need to get the hell out of that company, right? So we want to make sure their short-term assets in terms of their liquidity can pay off the short-term and long-term liabilities. And it's true, they can, right? At a $539 million, just shy. And again, they just, they did their share offering. So I think they have near $1 billion in cash, right? So we're good in terms of them having to do what they do during operations, right? So now let's talk about my favorite part, right? Here is the financial health of the company. So I created this graph. All these graphs I created, except the ones in the end that we will be discussing. And as you can see, through March 2021, Clover Health has been decreasing their debt as indicated by the smaller red debt line here, or the debt bar line. And the equity, it's interesting here, it was going down, but then from the data, it started going up. But the problem is, look at the cash, guys. The cash started going down. And in fact, I was actually fearful of this because I was like, wait a minute, can this company have enough gunpowder to be able to weather the storm, to create a product, the Clover Assistant, and all the lives under management to be able to turn a profit here? And would you look at that? This was in September. In November, they went ahead and did a share offering and they injected liquidity into the company. Now we're, I think, sitting around $800 million, $900 million. So that saved the problem. Now let's look at the debt to equity. Now, what that does is it takes the debt and divides it by the equity, and essentially the lower the ratio, the better. So if you look at Google and a lot of these other amazing companies, usually at times of catastrophes, when the Federal Reserve decreases in interest rates at 0%, companies and businesses, they tend to take on a lot of debt because it's cheap. It's actually cheaper than money, right? So by doing that, it tends to increase the debt to equity ratio. But then once the Federal Reserve becomes more hawkish, they tend to decrease it down during those times. And that's indicative when you look at Google's 2014, 2015 earnings in terms of their debt accumulation, and then they slowly started to taper off. And then once the Federal Reserve decreased interest rates during the 2020 pandemic, then they shot back up and now they're decreasing off. So a lot of good companies now are decreasing. And if you see any companies that are increasing their debt to equity ratio, then that's not good. So Warren Buffett always likes companies with a debt to equity ratio under 0.5. We're not even near that, guys. This company's obviously, it can't have control over the pandemic. It can't have, it can't have control over, how people take in the Clover Health markets, all the short sellers and all these things, but it does have control over the balance sheet, and it's doing a really good job. So now I want to talk to you guys about this graph. Now, this graph is extremely sad because retail investors here in yellow were the knight in shining armors of the stock. They knew the value, they bought it up, and unfortunately now they're selling because the price drops. Again, the more research you do and the more due diligence that you do, it helps you when there's downturns, right? But a lot of these individuals, they bought the stock because they just swiped up on Robinhood or someone told them to. And when the stock came crashing down, again, short sellers and a lot of manipulation in the market, fears of the recession, all these things, right? Inflation, CPI, everyone in retail, unfortunately, were either margined out and they had to sell, which is sad because guess what happened? We had institutions like Bally Gifford, all the other stuff that I talked to you guys about. I will make another video regarding a total of all the big dogs that bought. But again, right now, the institution level right now is higher than 20%, guys. And again, this is not updated because I have to look at individual insiders and also venture capitalists and firms that also bought the stock. But expect the institutions right now at higher than 20%. And you know what happened? Retail sold. They bought high and did absolutely opposite of Benjamin Graham's perspective of the intelligent investor. They bought high and they sold low, almost like donating. Like, here it is. Here's my nonprofit. Here it is. I'm donating you cash. And unfortunately, retail always loses, which is why I created these platforms here to help give a fair shake for retail on Wall Street. Okay. So now there's a lot going on in the market this week. Mid caps and small caps are reporting. This is huge. And I'm going to just walk you through a couple of things that I'm going to be looking at. All right. And please comment down below other companies that I've missed that maybe I'm not looking at and I should. So first one is Weber. Now, you may be asking, why do I like barbecuing? No, I don't. I have a Weber. It's a great product, but I don't really care about the stock. I care more about the short squeeze of it, right? It's ranked high on, in terms of 25 in the top short squeeze ranked based on leadership boards and whatnot. And I believe that if they report killer earnings, they are going to short squeeze. Now, again, I did look at the fundamentals. I believe they are free cash flow positive. So I do believe it is undervalued. So that will be fun to pay attention to, especially in pre-market open, as you can see here before and after, right? If you don't know how to read this, this is the first time that you guys have seen this. On Tuesday, I'm going to be looking at Marriott just to kind of get a sense, again, with Hilton here, to get a sense of where travel is and is the consumer spending, right? Are they traveling? Because if you look at the University of Michigan with the consumer sentiment report, it shows that consumer sentiment is decreasing. And if consumers stop spending, we're going to head to a recession. I don't care how many billionaires and millionaires there are. If the consumer's not spending, the economy and GDP is going to slow down, which we already have seen with forecasts from Apple and all the big tech companies. Okay. Roblox is huge. Shout out to Nancy Pelosi. And then we have also Airbnb, again, funneled in with Marriott, but also a little bit of tech. Shopify is a huge one. I want to see what's going on here. If it drops, I'm going to go ham on it. That's good. Crocs is undervalued as well. I want to take a look at them. They have, I'll be creating an intrinsic value analysis for my course members here. And if I have time to make a video, I'll definitely do so. This is an undervalued. We already talked about Hilton. And NVIDIA is a really huge one in terms of the chip manufacturing companies and whatnot. We already put a price target on our course about that company. We're going to be looking at it. If it drops even more, I don't think it will because of semiconductor chip shortage. We'll see. But it's definitely one of those good stocks. I think it overtook Facebook, right? Or Meta, right? We also have Matterport, which is kind of glued in a little bit with Facebook. If you have an Oculus, you could see a couple of advertisements from Matterport on there. And I do believe that this stock is going to have a voice within this new metaverse that we're going into. Energy Transfer is a huge one. It is a dividend darling. It was a hit. I remember purchasing it when it hit around $3.80 or something, near at book value when the pandemic happened. Amazing dividend stock, guys. I expect them to continue to raise their dividends higher and higher. This is a great dividend stock. Again, for now though, because I do believe pipelines and all this other stuff is going to be washed away with this EV. If you guys haven't checked out the Super Bowl, there were so many EV commercials. It's definitely the future. I have Cisco. No, Cisco's not highlighted. It's just all the boxes around it highlighted. I don't really care. DoorDash is really good. We're going to take a look at that. Fastly, another one of those, retail tech plays. I do believe it's overvalued still. I need to take a look at it, but I'm going to be looking at it. Palantir! That's a big one. All right, guys, this is a big one here. I do think that Palantir is going to be $1 trillion company. The question is when, and I know it's not going to be anytime soon, but we're going to look at this. If this drops, I might have to sell my kidneys. I don't know what I'm going to do here, but Palantir is a big one. It is a big one. It is essentially artificial intelligence is the future. They have a Foundry and Gotham platform. The Gotham is used for their military and CIA services. And then also the Foundry is when they essentially use it for commercialized products. BP Energy uses them. They saved so much money. I'll go into a more detailed analysis with Palantir, but just expect, someone with a coding background, I love Palantir. I mean, it makes things so easy, and we'll talk about it. Walmart is another stock that you want to basically look at to understand what's going on with the supply chain issues within the economy. Fiverr is a good one because everyone wants to, with the pandemic, everyone started finding themselves. People stopped working for their boss that ultimately didn't really care about them, and people started investing in themselves. So I do think this is going to be huge, especially with the increase in LLCs being created, my God, for the past 2 years. AutoNation is huge with the CPI data coming in. with the used car sales. Again, that's not sustainable. And I want to take a look at this stock more so possibly for shorting it. We'll see right now. If it is high, it is overvalued, but I need to take a look at it. Tower Semiconductors, huge one in terms of the space, especially with NVIDIA. If you want to know where that's going, check this one out and then look at this, right? Ruku's a big one. Shout out to Kathy Woods, Dropbox, and then DraftKings here. And then I'm going to just put my name, my picture up here. Just take a screenshot of this. Let me know if I missed anything and comment down below. Also highlighted here, Upstart. We also put a price target on that. I think over $200 on our private Discord channel there. But all right, guys, this graph here may upset you, but you know, this is why we need to hedge and understand the market, right? So to read this correctly, anything above zero means that value stocks beat out growth stocks, and anything below obviously means growth wins. So just take a look at 2014, 2015. Value stocks were winning because people were very fearful of the taper that the Federal Reserve was going to do during those times. And then after the stocks went ahead and had a bad time, growth stocks, I'm saying, they came back, and they came back with a roaring vengeance. Now we have the same problem. Value stocks have taken over. In fact, we are in a value bubble, which is why I told all of my course members to basically get out of these types of value plays in terms of these types of stocks here. I remember, if you recall, I made a video on ExxonMobil. I also put price targets on Bank of America stocks. These stocks have done extremely well, while the tech sector has not, right? And that's why it's important to understand the market as a whole. You know, that's why I wanted to bring my 10 years worth of experience here, because by utilizing this, you really know how the market fluctuates. People just move their money in and out of the market, right? Now let's talk about this one. The biggest takeaway here is a lot going on. I'm not going to go over it. The biggest takeaway here is if inflation goes up, wages go up. And the issue here is that the CPI data came in at 7.5%. You know what I think with the CPI data? I think it's all a lie. I think it's all these numbers are all backdated. My way of gauging inflation is by looking at what the stock market's saying in terms of what are the earnings report of billion-dollar, trillion-dollar businesses saying? What are big real estate investors saying about rent? The CPI data is not correct. And I think, personally, we're sitting at a 9% right now in inflation. And if you did not get more than a 9% or 10% raise, you are losing money. And do you think businesses are going to raise you up that much? No, they're probably going to do 4 to 6%. Again, you're going to get sucked out of your money. And as soon as the consumer starts to feel less wealthy when they go to the market, especially with all the produce going up, they're going to stop spending. And that's not good for our economy. All right. So in this graph here, Goldman predicts there is going to be 7 rate hikes, right? We're at 0 right now, and then 7 more to come. And unfortunately, I believe that the Federal Reserve is late to the game. And the more they keep prolonging this, the worse the market's going to get. In fact, if they don't increase this higher than what we expect, or if they don't somehow do an emergency increase in February, then we are going to get a short-term rally, but understand that it's going to be met by vengeance and a lot of selling in the market in the future. So understand how that works with the economy, but just find good companies that are undervalued and continue to dollar cost average and ignore this noise if you don't want to hear this. Okay, so this is very important, right? This is called the equity hedging index. Every time we get into an area where so many people are starting to short the market, it's a signal that the market's going to reverse. Remember, whenever you start to see retail investors saying, I don't want to get in, I'm going to just probably short this market, or I'm shorting this, they're not contrarians, right? You have to be a contrarian thinker in order to win the market, right? And a lot of these people are following, right? And by the time they follow, they get scooped and they get rug pulled. And all of a sudden, the market just hits that signal. And just like any other signal it got hit. And then it basically increases up, to the moon, right? So understand that and make sure you hedge for that, right? So what are we going to do about this guy sitting, relaxing? Look at all the oil in the back he has, right? I'm just kidding. That's a beautiful background. So the problem that we have with Russia is that, this guy has a legacy to maintain, and he wants to reunite Ukraine back into Russia. And this is not, I'm Middle Eastern. This is not like a Middle Eastern country where you can just go in and manipulate and not affect the global economy. Russia controls a lot of the oil exports into the European Union. And if they try to mess with that, he can just essentially dial that off. And then what's going to end up happening to the oil in terms of the oil barrel prices, which is why I sent out an alert to all of my course members and Al Stock Alerts Pro on the Patreon to say, hey, it's important to hedge now with undervalued oil stocks, right? Not probably ExxonMobil, even though it would go up, or other stocks that would go up even higher, right? So we need to pay attention to this. It is going to have some market volatility, but just like I have a graph, I'm not going to put it because I don't want to extend the video for too long. It is essentially going to cause some short-term volatility, but again, short-term is the key. We're going to get back to baseline, okay? So now, it's very difficult to create a lot of these videos, and every time something happens in the market, and as you basically can see, there's a lot going on, it's hard to create a video. So I sent out these alerts. I think now we're running close to over 100 stocks analyzed, and we're talking, high quality analysis techniques that it goes 10 years into the future and discounts back at a 10-15% discount rate utilizing a free cash flow model. And I dialed that down with an easy graph that tells you where the stock is at now and where it's going. So if you would like to support the channel, I would recommend the basics. This is not active yet, but we will be activating it soon. Any funds that circle in to this channel will be reinvested back into the channel to create a high quality stock analysis channel that will give you guys the best with no influences, no outside influences. I have turned away a lot of people that want to go on sponsorships that essentially take advantage of small channels that have a following that unfortunately like to take advantage of the subscribers. That's not going to happen here. Okay, so if you support this channel and if you want more information on all these buy and sell alerts, there'll be a link down below. As always, it is an honor and privilege to serve you guys. If I have earned that like and subscribe, I would appreciate that. It means the world to me. You guys have no idea. God bless you, and please stay safe. Goodbye.